And I think the problem is that the minute when you start overextending yourself on debt, whether it is that vehicle, that home loan, those revolving credit facilities, we know that people then struggle with that repayment. They start falling behind.
Essentially, as you highlighted earlier, debt has a great influence if you use it correctly to purchase income-generating assets or help you just acquire a skill that in the long term will then be able to reap the rewards from. Let's talk about the influence of debt on different stages of one's life.
Don't wait to start learning about investing and getting involved with it until you've cleared all the debt that you have. Because the risk then is that now you've got rid of all your debt, but you still don't know how to do the building wealth, the growing wealth bit. And before you know it, you're back in the debt trap. So these two things need to be done sort of concurrently.
Hello and a warm welcome to yet another episode of the JSE Investor Avenue podcast series. I'm Gugulethu Mfuphi and it's great to touch base with you in the new year. This time, a whole new special season of conversations is what we're bringing you as we maintain the momentum that we've been driving here on the JSE Investor Avenue podcast series to help you navigate your investment journey. And it's not just about understanding the little nuances into the markets, but also understanding your psychology, your approach to money, your behavior, and how all of this influences your approach to long-term investments. Well, today we thought we'd dig deeper into this particular theme, not only by providing you with some context and perspective into a financial dynamic we all have exposure to. Debt. How are you managing it? And I ask this deliberately because depending on where you are in life, the kind of experiences and exposure you have, these could all play an influence as to how you establish your long-term goals. So today we're going to take a look at debt, how we navigate managing it effectively, especially regarding the different stages of life that we approach, but also understanding how it shouldn't take away from your investment journey and long-term financial objectives. So, to help me in conversation for that, we're joined by Liana Henning, who joins us from Interface to help us unpack this dynamic and most importantly, just have a better approach to our management of debt. Liana, excited to speak to you and welcome to the show.
Good morning and good morning to all the listeners out there. Such a privilege to be here today. Thank you.
I'm excited and I'm glad that you have positive energy around it, right? Because so often when anyone hears anything to do with debt, we tend to pause in our steps and stare wide-eyed. But the truth is debt typically gets a bad rap in terms of not being used effectively. And we know that there are pros and cons to debt, like with anything else. But maybe let's just start there. The dynamics of debt in South Africa and how we should be using it effectively as part of our wealth creation and money experience that we have on a day-to-day basis.
Thanks, Gugu. Yes, I think, debt for many people, when they hear that four-letter word, they want to run in the opposite direction. But of course, we need to be realistic and we need to, first of all, just unpack and understand the impact that debt could potentially have on your life in those different life stages. And by looking at some of the recent numbers, we know that many South African households are struggling with debt. If we look at the statistics, our debt to income ratio is sitting at around 76%.
Yeah.
So that simply means for every 100 Rand earned, 76 Rand is spent on debt, leaving very little disposable income to actually cover all of the other living expenses. So one could argue and say, yes, but if I've got a home loan, if I've got vehicle financing, a couple of short-term debt facilities, I could very quickly get to that 76% debt to income. But of course, we know that's made up mostly of short-term revolving credit facilities.
Yes.
And when we dig a little bit deeper, we actually see that people are using debt to supplement their income. They're using it to fund their lifestyle. So for all the wrong reasons, not to work towards creating wealth and to be more aspirational.
Got you. And maybe let's touch on that, right? Because many South Africans might actually say, but hold on, I've got access to the debt, I can afford it, I'm actually good for it, so why can't I use it to augment my income versus some of the alternative options that we really should be considering debt for?
I think when you start utilizing debt to fund your lifestyle, that should be an alarm, going off somewhere. It is vitally important from a financial wellness and coaching perspective to start with a budget and to make sure that your income that you are earning is actually sufficient to cover all of those expenses, your fixed, your variables, your discretionaries. You shouldn't be relying on debt, to supplement that because it's costly. Some of the short-term debt facilities can go as high as 35%.
Yes, in terms of interest.
And I think that's typically where people start to struggle, because taking out that facility, you might think I'm comfortable with the repayment, but when you start looking at the interest that's being charged, that's usually where the problem comes in.
Because that interest in itself is money that needs to be paid back timeously, and it also plays an influence on one's credit score and credit behavior, right?
Yes.
Got you.
Absolutely. And I think the problem is that the minute when you start overextending yourself on debt, whether it is that vehicle, that home loan, those revolving credit facilities, we know that people then struggle with that repayment. They start falling behind. And that's then the negative impact, because you might go into having a judgment against your name. There might be a repossession of that vehicle or that property that's going to place you in a much worse position for the years to come.
Liana, in a moment, I want us to take a look at the dynamics as to how debt impacts and influences different generations and their finances. But before we do that, I'm really intrigued just to get some insight as to how far we've come as South Africans when it comes to our debt behavior or debt management, especially post-pandemic, because there was a time when you had to do a lot of work reminding South Africans to remain calm, disciplined, focused, and just riding out the wave, especially on the back of the shockwaves of the pandemic. Since then, how have we done?
Yeah, I think to go back to 2020, that dreaded time, when unfortunately many households were hit with unexpected loss. It was loss of income, loss of a loved one, which placed them in financial difficulty. And many South Africans then tapped into short-term debt facilities, extending home loan terms, taking further advances to actually get through that. And it's taken them such a long time to actually navigate through that and to get back on track. So yes, when we look at some of the stats, people are still feeling very stressed about their finances. They're feeling worried, but there is a bit more optimism when we look at some of the surveys that's been completed by South Africans. They're starting to feel a bit more positive around what's happening. We also need to be mindful, of course, that prime lending rates have come down.
Yes.
That's very positive. And we're starting to see a bit of a shift in terms of the credit landscape again. Banks are a bit more eager to assist with loan facilities depending on affordability and credit risk rating. And then, of course, we know that consumers are now starting to take a look at, can I actually get into, for example, the property market? How much is this loan going to cost me over the next 15, 20 years? So altogether, I would say it's starting to look a little bit better.
Well, we're glad to see that. And as you say, even the property market booming, which actually shows us then perhaps a slight shift in terms of what we're using access to debt for. And essentially, as you highlighted earlier, debt has a great influence if you use it correctly to purchase income-generating assets or help you just acquire a skill that in the long term will then be able to reap the rewards from. Let's talk about the influence of debt on different stages of one's life. And I say this intentionally because depending on where you are in life and some of the windfalls or shortfalls you might be experiencing, there are different reasons as to why you tap into debt. But let's start off with the young graduates, someone who's just in their 20s, done well academically, now perhaps pursuing to build up on their career, move around the country as often as they can, or even take up new opportunities to upskill themselves. What should they be considering around debt? Because this also comes at a time in your life where you don't necessarily have a very detailed credit record.
One of my favorite life stages, dealing with the young professionals. And I think what we need to be careful of when entering the job market and starting to work, earning that income, there is a lot of things that many of them need to be mindful of. And yes, of course, there's lots of pressure. There is social media, and it's all about, what car do you drive? What accessories do you have? Where did you spend your weekend? How much did you spend on this particular item? And that is the pressure that these youngsters need to compete with. And on top of that, for many of them, the reality is family support.
Yeah.
Now that they've been through maybe their studies, or they're an intern or a graduate or whatever the case might be, many of them might be the very only one in that family dynamic that's earning an income. And the expectation is that they need to give back and they need to support parents, extended families, siblings, elderly parents, and the squeeze in the middle is becoming increasingly tight. So there's two ways of looking at it in terms of getting into debt at that young stage. I'm finding the option that I've just discussed with you is that they then fall into the debt trap because there's so many expectations. And because they've got a career ahead of them, there's maybe a fixed income, it's easy to get credit by building up your profile with short-term debt, credit card facilities, etc. But they're not managing it effectively because there's so many demands. On the other hand, if you get into this space and you want to be aspirational, you want to finance a property, you want to maybe finance that vehicle, it's almost like a catch-22 situation. You need credit in order to get more credit. And how do you build up that credit profile? And that's where it's important to really ask the question, what can I do in order to get that healthy credit score?
Yes.
Because if you've got a healthy credit score, the loan term is going to look much better. The interest rate is going to be much better.
Definitely. Liana, you touched on an important point, right? Because there's different methods to actually building a healthy credit score. But I think there are some significant guidelines to be mindful of. And typically, when you're in your 20s, it's typically said, just build up and accumulate some credit. Open up a store account. Do this, do that. And that's one aspect. But they're not implementing or teaching us the behavior we need to embody to actually build the healthy part of the credit score. And I think that's important for us just to reflect on. It's not just how much access to credit you have, but how often and sustainably you pay it back, because that essentially determines the health of your credit score, right?
Absolutely. And I think we do need to mention the importance of taking a look at your credit report at least once a year, because that is going to show you your credit behavior. It's going to show you the type of accounts that you currently have, how you've been paying that account. Yes, we often give guidance where your bank account is, if the salary is being paid in. Start by applying for a credit card with that institution with a very low limit. Pay some of your monthly expenses on the credit card, but get into the habit of settling that outstanding balance on a monthly basis. Why do you want to do that? Because when you look at your credit report, literally every single month when you pay that account on time, you get a little green mark, good tick, you've paid that account. But the minute that you pay that account late or you miss a payment, it's got that negative impact on your credit risk profile. And when you do that on an ongoing basis, when you're now ready to apply for that vehicle or you want to apply for that home loan finance facility, the very first thing the credit manager will do is take a look at your behavior. Well, how have you been paying this credit card or this little retail account? And if they then see that there's irregular payments, over the last 6 months, you've missed payments, they're immediately going to decline your application for that property or that wealth creation because of that behavior. So make sure you pay on time, pay the correct amount, don't skip payments, try not to jump around between different facilities. Very often people apply for those month-end loans. And the more you do it, every single time you apply for that facility, it leaves a footprint on your credit report. And that has an impact on your risk rating and your score and your behavior, which ultimately could have a negative impact on your future applications.
Got you. And I hear you, because there's always an alternative, right, that one can consider, whether it's a credit card or an overdrafts facility on their check account. So you're quite right. The behavior is really making sure you pay back and you pay on time. That is actually what will differentiate the level of success versus just paying lump sums or overpaying on a specific account, thinking it will get you further. I'm glad you highlight these, because you've built the career then in your 20s, you're a young graduate, you buy the car, you purchase the home, you meet someone you love, you get married and you have children, or any other form of partnership that one might want to establish. And this is where things tend to get a little bit more serious, right? Where perhaps the responsibilities do pile up. Children of your own or other dependents, parents getting elderly and perhaps more sickly and fragile, and that potential squeeze that we touched on that middle generation perhaps being a lot more amplified. or whilst there's still ambition to make sure that you yourself are growing in your career, you are living in spaces and a life of comfort and to your preference, how then do we need to look at debt in that particular time of our life?
Yeah, we refer to the sandwich generation. So exactly what you've explained now, that squeeze in the middle and so many goals that you still want to achieve, but wanting to make sure that your kids are taken care of. If there's an extended family relying on you, once again, my caution would be careful not to try and fund this through short-term debt or extending loan facilities. And
even though you might have gotten an increase, a couple of increases, maybe a bonus, and you think, hold on, Liana, I'm good for it. That's typically the response you get, right?
Absolutely, because I think it's where you need the guidance from a specialist, whether it's a mentor or a coach or someone that can really take a look at your full portfolio and look at that debt to income ratio so that you don't overextend yourself. But in that generation or in that space, I almost want to say boundaries are vitally important.
Yeah.
So it's important to calculate how much are you contributing of your income towards family support and your kids and your own needs, and balancing all of that and really just saying, let's have this conversation. I don't want to become reliant on debt in order to support everybody. I do want to progress, because at this stage, you might want to have that property or that second property. You're really thinking about your retirement and how you could potentially fund that, but also taking care of the extended family and starting to think about, well, you should already, if there's kids, what would their future look like in terms of further studies? How am I going to fund this? And I think if you make wise decisions, maybe, for example, if you've got a property and there's a loan on it, have you over the years increased that payment so that you can minimize the outstanding debt? Have that surplus funds available in that facility so that you could potentially utilize it for studies or a deposit on that second property or whatever the case might be.
Got you. What it also seems as though you're reminding us of, Liana, is that we need to be a little bit more mindful of our budget, because yes, the salary increases, the bonuses, the new income streams might come about, but it's not about finding new ways or new things to spend that money on. It's about using it more wisely within the budget that you actually have and that particular scope. Are there ways and tools that one can prioritize? And I say this because there's often that balance between the everyday bread and butter issues versus the long-term savings and investments that we're actually driving for. So are there tools that we can be mindful of and making use of?
Absolutely. And, you refer to what we call the lifestyle creep. So whenever there's a salary increase or a bonus, it's not a target. You shouldn't immediately think, what more can I afford? Can I increase this facility? How much more do I qualify for? So from a financial wellness perspective, we would always give guidance to say, when you receive that increase or that bonus, rather try and minimize what you already have. So if you do have loan facilities, what percentage of that can you utilize to minimize the existing debt, specifically the short-term debt where it's at a very high interest rate? Boost your retirement funding, see if you could maybe take some of that and supplement. Look at the longer term debt like home loan facilities. If I do pay in additional into my facility, what is the benefit going to be? Because ultimately, as much as we are receiving that increase, hopefully, if you're fortunate enough on an annual basis, we know that everything goes up. Cost of living increases much more compared to salary increases recently. If you take a look, the average increases could potentially be between 3.5%, 4 to 5%. Real cost of living is a lot more. So if you're constantly aiming to get more debt and more facilities once there's an increase, you are definitely going to start running into trouble.
Got you. Okay, so be careful of lifestyle creep and being cognizant of how to manage that effectively. Let's talk about retirement or close to retirement, because this is a stage of your life where we often think, well, things are easier. You've accumulated much of your wealth. You've paid off your property or your home. You've managed to put some money on the side for your long-term retirement savings. Is debt still something that should be considered, especially if one happens to find themselves under immense financial pressure?
Definitely not. Nearing retirement, you should actually 5 or 10 years before a retirement have that check-in to see what debt exposure do I still have. And why am I using this debt? Once again, I go back to the point. Is it to supplement my income? What was the reason? Was there an unexpected emergency and I tapped into this facility? 5 to 10 years before retirement, the goal definitely should be to try and minimize all of your debt as quickly as possible. You really don't want to wake up that morning of your retirement and still have a home loan facility that you need to pay back. Gugu, you've got to imagine this, how hard it is currently for so many South Africans to just stay afloat with cost of living and all of the commitments and working and trying to cover it all. Imagine how hard it will be for many South Africans waking up in retirement with reduced income, but still having to compete with all of these living expenses plus debt commitments. So my guidance would be also don't make big decisions within the last 5 years in terms of financing this new flashy car and you've got to repay it within the next couple of years. I would definitely say minimize the debt, make informed decisions, and rather try and supplement your retirement funds because we've got to keep up with longevity. People are living much longer these days. So imagine going on retirement by the age of 63, 65, and you're fortunate enough and healthy enough to live another 20, 25 years. You've got to ask yourself the question, will my income be sufficient with my current commitments, sufficient to carry me through, or am I going to run out of money?
Yeah, and I know it can be quite a complex calculation because you need to take inflation into account. But as you say, essentially, do I have enough money to get me by so that I don't run out of money? And for many that might be watching, they're well aware that we've often had conversations here about investing and the importance of investing. Ultimately, we are the JSE. And I say this because when we talk about debt and we talk about investing, some people might feel like, hold on, these are two themes that actually don't align. But throughout our conversation, you've been highlighting that the long-term investment strategy still needs to be in place and it shouldn't be compromised by accessing debt, which can be used productively if allocated to income-generating assets or practicing the necessary behavior to pay it off effectively. So how should we be viewing this dynamic right across the age spectrum, regardless of where we're starting in our lives? And perhaps if one is overwhelmed by debt, should they hold off on their long-term investments? Or do you prioritize the long-term investments and then just pay your debt as and when you can?
Yeah, it is a bit of a juggling effect. It's all about the balance, I would say. So I guess it comes down to taking a look at your debt profile. What type of debt do you currently have? And then going back to the budget to see, is there room in my budget to actually save? Because ultimately we talk about minimizing your debt. You've got to save, you've got to create wealth. But is it even possible? And for many South Africans, it's not. There's a small percentage that can actually do that.
True.
So there's a couple of ways that you can look at it. There definitely is the balanced approach. So once again, it would go back to the budget, free up a little bit of cash. What is my return on investment? And we know that a wonderful return on investment is when you start settling your short-term debt, because the interest that is charged, like I've mentioned before, could be as high as 25, 30, 35%, depending on the risk. So nowhere really are you going to find that type of return on an investment. But what you could potentially do is this balanced approach. So take some of the surplus funds that you freed up in your budget, put it towards minimizing your high interest-bearing short-term debt, and then start building up with the balance, either creating that in case of emergency fund, because a lot of people do not have that. And then you start looking at what percentage of my income am I currently contributing towards retirement? Keeping in mind, you can contribute up to 27.5%. And then as you minimize the short-term debt, look at the medium term, look at the long term, and you slowly but surely increase those percentages until you get to a point where you are quite comfortable.
You must have worked with so many South Africans, Liana, who come from different backgrounds and share different experiences and perspectives. And I assume this means that, what works for one person might not work for the next. So as you've described, there's some key themes we need to bear in mind. But for all of us as South Africans sitting at home as we reflect on our financial position, how do we need to prepare for that conversation with a certified financial professional like yourself or your peers and colleagues in the industry? And I ask this because sometimes there's a sense of shame, denial, and I guess anxiety around how truthful we should be about the reality of our financial standing.
Absolutely, Gugu. And I think it is about the skill and the ability to make informed financial decisions. And we should move away from thinking we don't want to talk about money. We know in many households, couples don't even talk about money. So I think once again, it's about reflecting where you are in terms of your current financial position. Are you comfortable? Where do you want to go? So it is about setting those goals. And who should I be having that conversation with? And don't be ashamed. There's no shame talking around money. Rather get the help that's available and set those goals. And I almost say it's like having that responsibility buddy, someone that you can check in with, like a financial coach or a mentor or your advisor. You need to build up that relationship and check in with them on a regular basis. But to answer your question in short, it really starts with your budget. Yeah. What is the outcome of your budget? Are you breaking even? Are you seeing a shortfall? Are you seeing a surplus? And then, of course, it's about the habits. What are you willing to change? Because whether you speak to the advisor or the coach or the mentor, and they can highlight to you, this is what you need to do. But if you're not willing to change, then ultimately you're not going to see the difference. And it's about that discipline. And it's like going to the gym. You could go to the gym once a month, and you might complain and say, I'm not seeing a difference. So it's the same with your finance. You've got to do it consistently. Check in, motivate yourself, have that discipline, set time aside to manage your finances, and all elements, all the different areas, whether it is your budgeting, your goal setting, your protection elements, your prosperity. Very important to have those check-ins.
Okay. Goal setting, be very honest and robust about our financial standing, and most importantly, understand the goal that we're trying to attain, but speak to a professional. It might seem easy to do it on your own, but as we know, sometimes things do slip up, and that's why professionals like yourself do exist in the market. Liana, I'm excited to, peel back and learn so much more about this conversation and the lessons that we have to share, so much so that we're also going to hear from some of your colleagues in the industry. And one colleague in particular, Nerina Visser, is going to join us to give us some more insight in terms of managing your long-term wealth and investment planning by ensuring that you manage debt effectively and don't let it compromise on your long-term growth and objectives. So how about we hear from Narina? What do you say?
I think that sounds like a plan.
Narina, the floor is yours.
Thanks, Gugu. What a wonderful conversation with Liana. Such an important topic, debt and how to deal with it. But the whole idea is that we want to get to the end of this debt cycle or this debt trap. So what next? What do we do now? And so often we find with clients that we get asked, should I first pay off all my debt before I start investing? Or is this something that I can do, this learning about investing whilst I'm still paying off debt? And what I love about what Liana has shared with us is in terms of, let's call it bad debt, consumer debt that is really just focused on consumption and something that we want to avoid at all costs. But if you've got some existing consumer debt, absolutely prioritize getting rid of that debt because it's the bad debt, but it's also often the most expensive debt. And then there are, let's call it good debt that one can use basically to acquire assets. For example, a house, a home that you would buy. And so when it comes to this question, my recommendation is usually don't wait to start learning about investing and getting involved with it until you've cleared all the debt that you have. Because the risk then is that now you've got rid of all your debt, but you still don't know how to do the building wealth, the growing wealth bit. And before you know it, you're back in the debt trap. So these two things need to be done sort of concurrently.
I'm glad you mentioned that because time is often one of the concerns when it comes to building wealth, right? It's not timing the market, it's time in the market that we often talk about. And for anyone listening to this conversation, they can clearly tell that we've had this conversation a number of times. But where do we start then, Narina? Especially for someone who says, okay, well, I want to take care of the debt, but I also want to prioritize the wealth journey. What options are available and how do I prioritize my RA versus my tax-free or even just discretionary investments?
Yeah, very important to think in terms of not just what it is that you want to do, but where and how best to do it. So you mentioned things like a tax-free account or a retirement annuity or a discretionary investment, which is really any other type of investment, which, by the way, would include literally having a savings account at the bank. That's also a form of discretionary investment. But so when we look at these different options that are available, they each come with different benefits and different disadvantages. So we want to make sure that we maximize the benefits that we have without getting stuck in the disadvantages that might be associated with it. And quite frankly, we advocate for focusing on all three of those. It's not necessarily doing the one over the other or preferring one over the other.
So how do I prioritize this? Because it seems like so much admin, different products, different tools, or financial investment vehicles with different institutions. How can we manage them effectively?
So I think what's really your best ally in this process is automation. Spending some time planning what you're going to be doing, implementing it, but doing it as a regular debit order investment in particular. That automation is one of your best safeguards against falling back into that debt trap. Because often it's the money that hits your pocket that burns a hole in the pocket, whereas if it's set up in terms of a debit order to actually start working for you in the market, it's out your pocket before it can even burn a hole in your pocket.
Makes sense.
So what are the priorities as far as I'm concerned? Most important priority after getting out of debt is making sure that you've got an emergency fund, because other than lifestyle creep, consumer type debt, that's often one of the biggest reasons why people end up having to go into debt, because life happened.
Got you.
And so your best sort of protection against that is to say, make sure that you've got an emergency fund so that you do have something to fall back on, when life happens.
And we're clear on that. That's the geyser bursting. That's perhaps having to pay extra on your vehicle insurance, a loved one needing some medical health care.
Absolutely. That's the type of sort of shocks or lifestyle disasters that we can envisage. So absolutely, your emergency fund is a priority. And I think what is quite interesting is people often think in terms of emergency fund as, that must just be either in a savings account with a bank or in a fixed deposit, because you tend to get a bit better interest on fixed deposits. But actually on the JSE, we've got beautiful alternatives, interest-bearing money market ETFs that give you better interest rates than you're going to get at the bank, and without locking you up for the 12-month fixed deposit. Because what good is my emergency fund if it's locked up for 12 months? I got that crisis right now and I need that money right now. So often people associate investing on the JSE and investing on the market, that means necessarily risk. That means necessarily stuff that's going to go up and down a lot, or it's equities, it's all shares. But actually, when we look at exchange traded funds, the spectrum is so much broader, and it literally starts at something as low risk as a money market fund or an enhanced income fund. That is a very suitable vehicle for your emergency savings.
Got you.
So that for me is a great starting point.
Gotcha.
The next one that goes almost hand in hand with that is making sure that you maximize the tax opportunities that government gives us. We are in tax season, always in February. We've heard a lot about tax-free savings accounts. I'm going to push that boundary a bit and say, I want us to think about tax-free investment accounts.
Yes.
Exactly the same thing in the sense of the opportunities that you get, the fact that government allows each of us 36,000 Rand per year that we can contribute into such an investment account. But in a tax-free savings account, the only thing that you earn is interest.
Yes.
And therefore the only tax that you can save is the tax that you would pay on interest, which seems a little bit limited.
In terms of growth.
Exactly. Whereas if you go into a tax-free investment option, not only do you also save any tax on interest that might be earned there, but you also don't pay tax on dividends. And over the longer term, most importantly, you don't pay tax on capital gains either. And if we really want to grow our wealth over the longer term, and the main aim, faster than inflation, otherwise you end up just getting poorer in real terms, we've got to go for capital growth investments as well. So my next priority after the emergency fund for me would be to say, see how much of that tax-free investment allowance that you have every year you can make use of. 36 might be a stretch target for many people. For others, it might be, I do it quickly on the 1st of March. Doesn't matter in what position you find yourself. Make sure that you maximize within your abilities the opportunities that tax-free investments give you.
Got you. And that's important because there are long-term benefits to that, as you say, as it as tax-free. To close off with, Nerina, for someone, this might be very complex or might seem as though it's very complex, where and how can they get the best value of financial advice to guide them as to how to manage this dynamic of managing their long-term investment strategy, as you've highlighted, but also managing and tackling debt in the short term?
Yeah. You know what? The value of financial advice is absolutely paramount, but there's a lot that we can do without necessarily having to pay a formal advisor or go through a formal advice process. So the ideas of paying off your debt, making sure that you get rid of that, investing, building up your emergency fund, investing in a tax-free investment account, those are typically not actions that require a paid advisor to tell you what to do. So if you're going to be dealing through a registered investment platform such as ETFSA, for example, there's the opportunity there for you to invest in this range of different products, giving you these benefits, making use of the wonderful range of ETF opportunities available on the JSE. They can give you guidance, they can give you the assistance that you need, but it's not a formal advice process for which you need to pay. It also allows you to learn as you go along on this journey, empower you into a position where you feel confident making some of your own decisions, but knowing that you've got this co-pilot of a financial advisor next to you that can help guide you through this process of long-term wealth creation.
Got you. So it's a partnership. We're in it together and we're in it for the long haul. Even with the short-term waves, we make sure that we are adequately prepared financially.
Absolutely.
Narina, always a pleasure speaking to you. Really enjoyed the insight that you've given us today and reminding us of some of the fundamentals we need to put in place. Thank you again.
My pleasure.
Well, as you've heard, we've gotten two of the best to give us some of their insight as to how we manage debt. Yes, and using it for the right things. Income generating opportunities, whether you're building a business, purchasing a vehicle, or most importantly, purchasing a property that at some point will be worth more in the future. But that shouldn't deter you if you're still stuck paying off your debt, to make sure that you prioritize your long-term investment opportunities. And there are tools and most importantly, investment vehicles and options available for you to tap into. So don't hesitate. Make sure that you reach out to the various platforms available and, of course, institutions that are acknowledged, regulated, and well affiliated with the JSE to give you some insight. But share your thoughts, your comments, and your feedback with us. And, of course, let us know what you've learned from both my guests here today. Not only Nerina Visser, Director from ETFSA, but also Liana Henning, who joined us from Interface today, helping us navigate the trajectory around debt. Until next time, it's been a pleasure. Take care, and we'll see you at the next JSE Investor Avenue podcast series.